Not all investments are the same in the eyes of the IRS. If you're not paying attention to how you're making the money, you could be overpaying on taxes in the process. So I want to talk about the 3 ways in the eyes of the IRS that you can make money. There's interest, there's dividends, and there's capital appreciation. So we'll start with interest. Interest is when you've loaned your money out with the promise to get it back plus some interest for the inconvenience. So think of things like bonds, money market, CDs. If you were the holder of the mortgage, you're getting interest paid to you. So you're loaning your money out with the promise to get back, you receive interest. Dividends are, I've invested in the company makes a profit and chooses to share it with all of their shareholders. That's treated as a dividend. And capital appreciation is when I've bought something and it grows in price. So I paid $100 a share for Amazon, it moved to $150 per share, I made that $50 delta, that's a capital appreciation. When it comes to taxes, each of these is treated differently. So interest is treated as ordinary income, which is not always the best. Dividends are treated typically as long-term capital gains, and there's some qualifiers that go along with that of how long you've been holding onto the stock. And capital appreciation, again, if you've been holding that stock or mutual fund for long enough, it turns into a long-term capital gain. What I like to point out here is it depends. If you're holding your investment in a qualified account, it doesn't make a difference. It doesn't matter if you're getting ordinary income, long-term capital gains treatment, like if it's in a 401k, IRA, 403b, HSA, all qualified accounts have that shelter over it. It doesn't matter how you make the money. If instead you're holding it in something that's not qualified, like a brokerage account, a joint account, a bank account, that sort of stuff, it makes a world of difference because these have differing tax rates to them. So, for example, we'll say somebody that's in a 22% ordinary income tax bracket, which is pretty common. You're paying 22% when you collect interest. That same person typically would be at 15% for long-term capital gains rate. Why I like to point this out is the first layer of it is you go, oh, maybe I don't want this sort of stuff in a non-qualified account. Maybe my joint account, maybe we shift away from bonds, shift away from money market, and maybe we lean on these things. There is still a difference between these two, though. Dividends, whenever they're declared, you're paying taxes on it. So if I'm holding a share of AT&T and they declare a dividend, that means it's going onto my tax return and I'm going to pay long-term capital gains taxes on it. Capital appreciation, on the other hand, that only kicks in when you actually realize the gain. So if I bought something for 100 and it grew to 150 and 200 and 250, the only time that it's taxable is when I actually go in and sell that asset. So that doesn't mean, oh, I only want to hold this sort of investment. What it does mean is as you're looking at different accounts, instead of just mirroring and saying, I have my 401k and I'm at 60-40, and I have my Roth and I'm at 60-40, and I have my joint account and I'm at 60-40, maybe what we need to be considering is, well, maybe this sort of account should be all of my interest-bearing stuff, and that means I should lighten up over here, and that means that my taxable account can go all towards capital appreciation, right? So maybe being mindful exactly where you have the assets located. It doesn't mean to change your risk tolerance, doesn't mean change globally how you invest. It just means if you're paying more attention, that you can keep more dollars in your pocket rather than forfeiting those dollars to the IRS or to your state government.